down payment assistance, it can be a good thing, but then there may also be some other things that your mortgage lender is not properly educating you on that could end up costing you more when you get to the closing table. Those are the things that we're going to be talking about in this episode when it comes to down payment assistance. So to start, down payment assistance has been able to help many people afford to be able to purchase a home and obtain that dream of home ownership. So in that sense, down payment assistance does have a good side to it. And overall, if you know how to properly utilize and navigate down payment assistance, then it can be to your benefit. However, a lot of people aren't properly educated on down payment assistance, so they don't receive that full benefit of the down payment assistance. And so when it comes to down payment assistance, there are a few things that you may not be properly educated on for one reason or another. And what we're going to talk about to start off with are interest rates. When it comes to down payment assistance, it's very possible that you could be paying a higher interest rate than what you would be paying if you were not utilizing down payment assistance. Part of that is the lender or entity that's providing you the funds for your down payment. That's part of the way that they fund the program, their down payment assistance program, to be able to continue to provide funds to other individuals. So let's say if you weren't using down payment assistance and you were able to get an interest rate at whatever point that interest rate is. If you were to use down payment assistance, the lender that's providing that down payment assistance might actually charge you a slightly higher interest rate. Again, as a way to sort of fund the program because they're giving you money. Now, you've got three different types of down payment assistance programs. You've got repayable down payment assistance. You've got forgivable down payment assistance, which means you don't have to repay it back. And then you've got sort of this hybrid between the two where it's not forgivable, but you actually also don't have to repay it back unless you sell the home, refinance, or move out and it's no longer your primary residence. So generally down payment assistance is going to fall into one of those three categories. Now, when it comes to interest rates, if you take a down payment assistance option that is forgivable, meaning that you don't have to pay it back, in many cases, the interest rate that you're going to be paying on your primary mortgage is going to be higher than it would have been if you had taken a repayable option where you were repaying that down payment assistance back. And so down payment assistance is essentially, you can look at it, if with the exception of the repayable option, for the outside of the repayable option, down payment assistance is a second loan on your home. Essentially, it's a second mortgage. So you have your primary mortgage, and the primary mortgage is covering the bulk of the purchase price for the home. But then you have a down payment requirement according to whatever loan program you use. Typically for down payment assistance programs, that's going to be an FHA loan. And FHA requires a minimum of a 3.5% down payment. So the down payment assistance in most cases is going to cover your 3.5%. That 3.5% that's being covered by down payment assistance goes on the home as a second mortgage. How that second mortgage is treated depends on the down payment assistance option that you select. That's where we get into the forgivable or repayable. So if that second mortgage, that money that was used to cover your down payment, is treated as forgivable, then whatever the terms are that will allow that down payment assistance money to be forgiven, once you fulfill the terms, that money's forgiven. But if it's treated as repayable, now that means that there could potentially be an interest rate associated with that down payment assistance portion of your mortgage, the second mortgage on your home. But the primary mortgage is what we're focusing on in terms of what I'm telling you, it could have a higher interest rate. So that's the interest rate on the larger portion of the mortgage, the one that's paying the bulk of the home, not the part that paid the down payment assistance. So for the primary mortgage, the one that's financing the majority of your home, the interest rate for that portion could be higher if you take a forgivable option rather than a repayable option, for obvious reasons, because a lender or an entity is giving you money that they're not going to be getting back. So in exchange, you might get charged a higher interest rate to help fund whatever down payment assistance program that entity or that lender has at the time. If you choose a repayable option, then your interest rate could be lower than what a forgivable option would be. However, the repayable option may still be higher than what your interest rate may be if you weren't using down payment assistance at all. It could be the same as what it would be if you weren't using down payment assistance at all. That kind of depends on your individual situation with your financial picture, but also with the down payment assistance program that you select. Because again, there are so many options across the board. I live in Georgia. Georgia Dream is a statewide program in Georgia that actually has really good interest rates to the tune of being currently lower than what the average interest rate is nationally, and in Georgia as well. So Georgia Dream has a really good down payment assistance program, but there are some other things in their qualifications, if you will, that you have to meet in order to get that down payment assistance money. We'll get a little bit into that when we get into another part that I'm going to talk to you about that you might not be as educated on. But that's the first thing I wanted to talk about was the interest rates. So again, you might have a slightly higher interest rate if you take the forgivable option versus the repayable option, but that's kind of the price that you may pay for getting, a bunch of money to cover your down payment and then not having to pay it back. So the next thing is increased closing cost. Increased closing costs come typically in the form of broker fees, and I'm going to tell you how that works. In many cases, when a lender is offering you down payment assistance, the lender that's offering you the down payment assistance might not be the lender or the entity where the actual money is coming from. Mortgage lenders partner with other mortgage lenders, other banks, other entities all across the finance industry. That's how business is done in the finance industry. No one mortgage lender has every single program out there. They often partner with other lenders that might have programs that they don't offer or might have better programs than the ones that they currently offer, just to give some more options. And so to put it in a scenario form, let's say that you have lender A that you go to lender A and you say, hey, I want down payment assistance to be able to purchase a home. And lender A says, absolutely, we've got a down payment assistance program. We can get you covered. We can take care of your down payment assistance. Lender A might not actually have the money that they're going to be giving you. What lender A has is a relationship with lender B, and lender B is the lender that actually is going to be providing you with the money. And so lender A goes to lender B and says, hey, I've got a client, they want down payment assistance. We're partnered together, so we want to use your down payment assistance program. Lender B says, cool, we'd love to have the business. So lender B, lender A makes sure that you're qualified under lender B's standard, and lender B is the one that's actually giving you the money for the down payment assistance. Now, since lender B is giving you the money, your payments and everything are actually going to lender B. Lender B is setting the terms for this agreement because this all has to be done under lender B's standard, because lender B is the one with the actual money. But lender A was sort of the intermediary, if you will, or the middleman. So how does lender A get paid? Lender A gets paid by charging what's called a broker fee. And that broker fee is what gets added on to your closing costs so that lender A can get paid for facilitating this transaction. Now, hopefully all of that made sense. If not, you might have to replay that part again. But in essence, you go to lender A has a relationship with lender B gives you the money, and you pay a broker fee for lender A facilitating the transaction. Lender A, you might see as being an unnecessary middleman. In some cases, that might be the case, but what I have found to be true in many cases, rather, is that there are a lot of wholesale lenders and a lot of mortgage companies rather that don't work directly with the public. So as you might go to a mortgage lender and want to get financing for a home, that mortgage lender that you go to might have relationships and partnerships with other entities in the mortgage industry that offer down payment assistance programs. But you aren't able to go directly to those other entities because they don't work directly with the public. They only work through other mortgage lenders. That's what I'm talking about in terms of it's not necessarily an unnecessary middleman, because you can't get to the down payment assistance funds if you take this route or this down payment assistance option without going through a mortgage lender. And that mortgage lender needs to get paid, so they charge a broker fee, which adds to your closing costs. So that's what I mean in terms of you could have increased closing costs, but the middleman, so to speak, middleman or the lender that you go to that's actually providing this down payment assistance to you, or at least linking you up with the entity that is providing the down payment assistance to you, is not necessarily unnecessary, because there might not be another way for you to get the down payment assistance without going through a lender that's partnered with the entity providing the down payment assistance. So that is the second thing that I did want to mention. So one, we've got interest rates. You might be paying higher interest rates when you take down payment assistance. But two, you also might have higher closing costs because the lender you go to, if they are not the ones actually offering you the down payment assistance and they're having to partner with another lender that is, then you're going to have to pay a broker fee in order to make sure that the lender that you went to initially, gets paid for this transaction as well. So higher interest rates, higher closing costs. The third thing that I want to mention, you could also end up with terms that you can't dictate or that you don't have any say in. So when you take a down payment assistance option, the lender that is giving you the down payment assistance money, the actual lender who has the funds that they're providing to you, is the lender that gets to dictate what the terms are. It's like, if you ever heard of the golden rule, a lot of people think, oh, the golden rule is, treat others the way you want to be treated. But in finance, the golden rule is he who has the gold makes the rules. And the lender that has the money that they're giving to you also can set the terms for the repayment or forgiveness of that money, whichever option that they have available to be able to offer you. And so those terms may or may not be pleasing to you. For example, there are some lenders that offer down payment assistance. They might offer you a great rate, but the down payment assistance is only repayable, meaning that you're going to have to pay that back over the next 10 years. If that's what the lender says you have to pay it back in the next 10 years, and they add that onto the monthly payment for your mortgage payment. If it's forgivable and the lender says, okay, I will give you the option to have it forgiven, then they charge you with a higher interest rate potentially. Whatever the terms are that they set for the down payment assistance, it could even be qualification terms. You know what, if you want this down payment assistance, you're going to need to have at least a 640 credit score in order for us to be able to give you the money to cover that 3.5% down payment requirement for an FHA loan. So in that case, you're going to have to work on your credit if it's not up to a 640 so that you can qualify for those funds. So again, the lender that's providing the funds or the money, it sets the terms for the funds that you're going to be getting for down payment assistance. So those are three things that can really shape how well down payment assistance actually is going to be benefiting you and working for you. Because if you're paying a higher interest rate, that's going to affect how much you can actually qualify for in a home, because your interest rate is also going to affect your monthly payment, and you're only qualified for a certain monthly payment. So if you have to pay a higher interest rate, that means that the purchase price at which you're qualified for is now decreased because your interest rate is increased. And so maybe you look at a repayable option, but if you have a repayable option, that means that the amount that you pay is also now included in your mortgage, which could also decrease how much you actually qualify for. All of that to say, you might not qualify for as much home with a down payment assistance program as what you would qualify for without a down payment assistance program. Again, that's not true with every down payment assistance program out there, because you have some really good down payment assistance programs that actually offer competitive interest rates. But you also might have to work on some other aspects of your financial picture in order to be able to qualify. There are some down payment assistance programs, again, that have higher credit score requirements than what FHA might require. FHA says, hey, if you've got at least a 580 credit score, you only have to put a 3.5% down payment down. But you might have some down payment assistance programs that are saying, you know what, we're going to require you to have a 620, or we're going to require you to have a 640. And since they have the money that they're going to be giving you, they can set the terms under which they will loan you that money. And so the terms is something that you really want to know what they are going into the down payment assistance, because it might be something that you're fine with, but it also might be something that you're like, you know what, I think I'd rather dig into my savings or dig into my checking to get the down payment assistance, rather than being set up with the terms of that are being, offered to you. Overall, I think that down payment assistance is a good thing if you know how to utilize it to your advantage. Some ways that you can take advantage of down payment assistance, I am going to be talking about all of those different ways on Tuesday. So every Tuesday, 7 p.m., I go live on a live broadcast, and I'm going to be discussing all the different ways that you can take advantage of down payment assistance and utilize it to your advantage. So you just heard about some of the things that can add to the cost or add to your interest rate or decrease how much you actually qualify for when it comes to a home. However, I'm going to be talking this coming Tuesday, or Tuesday next week rather, on some of the things that you can do to be able to help alleviate some of the extra burden that's put on by the down payment assistance. So you want to make sure that you tune in so that you can get that information as well, or just tune in every Tuesday, because I'm always talking about different things that are really going to help save you money and help position you in a better place to be able to take advantage of all of the benefits of being a homeowner. So thank you for tuning in. That's all that I have for you. Also stay tuned, because I have a credit repair course that is going to be coming out soon. I rather like to think of it as a credit education course, but what I'm going to be doing is literally, it's going to be a 3-day masterclass, and I'm going through all of everything that you need to know when it comes to credit, your credit in particular, and how you can get that credit to amazing. So you definitely want to stay tuned, because there's going to be information coming out about that very, very, very soon. So make sure you stay tuned, because if you're not in a position where you can purchase a home right now and credit is an issue for you, undoubtedly, I can tell you that credit issue is costing you tens of thousands of dollars. There are so many far-reaching effects of bad credit, from not only not qualifying for the house that could be building you equity, but also you're not able to take advantage of better interest rates, which means that you're spending potentially hundreds of dollars every month more on your mortgage payment, because you're not able to take advantage of those better interest rates. You're not able to you're paying more for your homeowner's insurance, because you're not able to take advantage of lower premiums for homeowners insurance premiums. If you go a conventional route, you're actually going to be paying more for mortgage insurance, because how much you pay for mortgage insurance is heavily influenced by your credit score. So there are so many, that's just a few of them. There are so many more far-reaching effects of having bad credit. So if credit is something that you're struggling with, please do be on the lookout. I have a course that's going to be dropping very soon. I'm going to start advertising it very soon. You're going to want to make sure that you tune in. It's going to be an amazing, amazing deal with a whole lot of information that's literally going to give you everything you need to take your credit from where it is now to 700 and beyond, so that you can start taking advantage of all of the benefits of having great credit and saving money, thousands, tens of thousands over the months and the years. So that's what I have for you. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you soon.